So why do we look at economic calendar events to spot high probability trading opportunities? Now, they don't always work out, and this week was a good example. We had an Aussie New Zealand dollar buying opportunity, expecting buyers at that 1.1043 high. The entry was triggered and we had stops under 1.0965. The buyers made complete sense. The RBA was considering interest rate hikes at their last meeting. The AUDNZD gave a much more dovish outlook and forecast a series of interest rate cuts coming, both central banks diverging from their previous meetings. The RBNZ accelerating, the RBA decelerating, and the RBA accelerating. So we had clear divergence. Aussie New Zealand dollar buy bias made sense. Now, sometimes you have to limit your risk. And in this instance, we limited the risk underneath that 10965 because the only other place we could have had our stops would be underneath that 10850 region. And that was just too far away to look for a target at that 1.100. So yes, an Aussie New Zealand dollar buy bias is still out there, broadly speaking. We can see the yield spread still trending higher. I'm actively looking for opportunities, but in this instance, we can see we're looking for momentum to stay above that trend line. You see what we're looking for is move up above. We had a break above, we had the entry triggered, so momentum was looking like it was on our side. We stayed just above the trend line, but then here, the trend line broke lower, and then we had the RBA minutes, which were taken to be more dovish, as the RBA said we may be able to stay with rates as they currently are, and that may be enough. So we may not need to hike interest rates after all, right? And markets look and say, okay, the RBA are not as aggressive as perhaps we enthusiastically thought after the interest rate meeting and after the RBNZ meeting. So the buy bias still remains, but the aggressive momentum buy bias just faded, and that was the place to take our stops. And you can see it's always better to be out of a market wishing you were in than in a market and wishing you were out. So that's why we look at these high probability trading events. This is why we look at economic calendar events, because they show us when the fundamentals are on our side, and broadly they're still on our side, but we need to see a better technical area to limit our risk where the reward is more attractive given the risk that we're having to take. So they don't always work out, but there is always plenty of new opportunities coming along, and this is an example that it didn't work out, and it's good for us to see them as long as the ones that do. So as we look at this calendar, what are the top 3 events that we can see coming up next week? Now, we've got some good ones. First, we've got the Aussie dollar CPI print. Now, this is going to be very important for the outlook for the Reserve Bank of Australia. In the latest minutes, the RBA said that it may be enough for them just to keep interest rates at current levels for longer than expected to deal with inflation. This CPI print is going to be crucial because if it comes in higher than markets are estimating, then that's going to change the RBA's outlook most likely and should give the Aussie dollar a nice lift against the New Zealand dollar pair. We'll take a look at the pair in a moment. We have still got an Aussie New Zealand dollar buy bias. This could be a catalyst for a fresh chance of an entry. Then coming up on Thursday, August the 29th, we have US preliminary GDP. Now, the outlook for the US economy is going to be quite key. Now, we'll have to wait until we've listened to Powell and the implications of his speech at Jackson Hole, which are taking place after this video has been recorded. So the analysis will be done properly next week. But the big picture is if we start to see a quicker and a faster slowdown than markets and analysts are expecting, that's going to bring forward the prospects of interest rate cuts, which should weaken the dollar and support stocks. So preliminary GDP will be important in terms of how the US economic growth is going. And if it's starting to show signs of weakness, that's likely to bring forward interest rate cuts from the Fed and maybe even bring forward the chances of a 50 basis points rate cut. So that's what we'll be looking at on Thursday. Friday, it's the PCE print. Please ignore that. It's not the UK PCE print. It's the US PCE print. It's just 1:30 UK time. This is, of course, a US indicator. It's the Fed's preferred measure of inflation and will be absolutely crucial for the outlook of the Federal Reserve. We're going to take a look at that in a bit more detail now. But these are the three big calendar events. I'm just going to jump now into some of the technical details that we have. As we see the Aussie CPI print, we'll be looking carefully at the Aussie New Zealand dollar pair. We had an attempt at Aussie New Zealand dollar long bias, but what pulled the Aussie dollar New Zealand dollar pair lower was the RBA minutes, as we've already mentioned. So what we want to see here, a hot CPI print could give us another opportunity on the Aussie New Zealand dollar pair. There is a buy bias. You can see that the 1 and the 10-year yield spread is trending higher, indicating there is a potential for higher prices. We can see prices just moving back down to this key support area with a nice hammer reversal on the daily chart, nice bullish engulfing bar in the daily chart as well. Very key support level. Wouldn't be surprising just to see a little bit of a technical bounce at any rate. But the Aussie CPI will be the best chance of more upside in that pair. Now, the preliminary GDP and the US PCE print. Now, if you look at the non-farm payrolls, we've had a revision of the jobs being added to the US economy, and markets were thinking that 2.9 million jobs were added to the US economy. It's actually 2.1 million after the Bureau for Labour Statistics revision from March 2023 to March 2024. So all of these are about like 68,000 lower than they actually are, and that's sort of what it works out on average. So yes, US economy is growing, but not as robustly as previously thought. So how's GDP doing? Okay, if that's showing significant signs of weakness, that could bring forward interest rate cuts. Short-term interest rate markets see 4 interest rate cuts this year. There's only 3 Fed meetings. So, that means they should, if they're going to hit the stir market price, and they've got to cut by 50 basis points, at least one of those 3 meetings. So that's going to be the major narrative. We'll get everything ready in the cheat sheet and won't leave you confused. But the PCE print on Friday is crucial. Okay, now you can see Fed's preferred measure of inflation. Look, it's trending lower. Okay, the Corey, it's trending lower. That's all assuring the Fed that inflation is under control. They're going to hit the 2% target. It's okay. Inflation isn't out of control. We can see break-even inflation rate. If we just look at this, more recently, fantastic. Okay, break-even inflation rate is down, under 2%. So what markets are looking for is that they are seeing a scenario where, let's just get this, let me just refresh that. Sorry, folks. Right, let's look at this more clearly. Okay. There we go, that's better. Right, you can see that the break-even inflation is 1.96. So in other words, from now, for the next 5 years, inflation is expected to be under 2%. Hooray, under the 2% Fed target. So inflation's all right. So that's what markets will want to, they want to see that continue to be the case. Okay, and the more that is the case, the more reassurance it will give that the Fed can go ahead and be more aggressive in cutting rates. So this will have a big impact on the dollar, big impact in US stocks, and this is some of the key things that we're going to be looking at for the coming week.